to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
And welcome back, everyone, to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning, AJ.
Good morning, Cyprian. Let's get to it.
Let's get to it. Today is March 18th, 2022. There's been big news this week. We've been leading up to it for quite some time, and that was the quarter basis point increase in the federal funds rate. And so what are your thoughts on that collectively?
I think more importantly, we knew that was coming. More importantly, as they hinted at, up to 6 more increases, right? They want to, their target Fed fund rate by the end of the year is between 1.75% and 2%. So that if you do the math, I mean, we've got about 6 more rate hikes. So every one of their meetings, they're planning on doing rate hikes. And then also in the fine print, we talked about this last week, they mentioned slowing down their buying of bonds or interrupting it completely. They didn't talk about selling them back, but rumor on the street is that they want to sell them back aggressively, at least about a third of that $9 trillion that they've created. They'd like to mop up. So that's going to change the dynamics in the next few years. It really is.
And right off the bat, the market seemed to welcome that news. We still are kind of rallying. So it may be one of those, the U.S. market is, thriving while the world is, in chaos a bit.
Maybe. And I question people like the talking heads are saying that, hey, we're on a rally. Maybe the markets are okay with this. But if we take a look at the charts, with the S&P 500 chart up, I'm going to switch because sometimes I like to just focus on the daily closing price, right? Because the daily closing price and even the weekly closing price, that tells us a lot. So I use just a simple 3 and 5 day EMA crossing to kind of tell me which of the reversals are for real versus which reversals are just noise. And so we had this reversal on February 2nd, and then the next real one we had was March 8th. And so if you count that as a downtrending range expansion, what that tells us is we better not be thinking that we're on some sort of rally until the S&P 500 is above, well, here it's down to the penny, it's 45.8938, but I'm going to say 4,600. Once it's above 4,600, we can believe that we're actually in a little bit of a rally. Otherwise, smart investors are very skeptical and they're looking at this as just a test of resistance before moving further down. So I'm looking at that key number at 4,600, a little bit less. If I want to get down to the penny, it's 459, let's just say 4,600. And if I don't hit that number before heading back down, I'm going to think that this current little rally that we're seeing is simply a test, what we call range contraction before going down lower. And I want people to know that because, if you don't look past the tip of your nose as an investor, you might start going long on these positions. And I don't think right now is the time to test that. It's not time to go long.
If anything, it's a great time to look at what positions you can take to go short because you will get a little bit, better pricing. And we'll go over some examples, but that's the beauty of options is we can look at signals and things to position ourselves for this potential pullback down.
Yeah, exactly. I mean, if anything, what this little range contraction move up was for you short-term traders, maybe it was a sell signal. For premium selling option traders, it was a signal to go ahead and put some option protection up there. So if you're shorted a position, let's buy some protective calls right now. Actually, that was yesterday's deal. It might be even a little bit too late to be doing that today, but buy some protective calls. And if you want to offset those protective call prices, you can sell some put premium And that would have been the strategies for this pullback right now, not just going all long into the market.
Does today's options expiration have any effect on any of this?
So the key thing that this options expiration, I don't think this options expiration is going to be quite that significant for anybody. The June, July, August, September. Is it quadruple witching today? I believe it might be quadruple witching today. But all that tells me is that, hey, all these options are expiring today. And so we should expect a heavy volume. And that volume isn't because of the normal buying and selling pressure. So a lot of people, including myself, like to use volume as volume validation. In fact, some of our favorite indicators, like accumulation distribution type based indicators, are based on what volume. And with this artificial volume coming from the expiring of derivatives, that throws those indicators off, and that also throws off volume. The volume isn't because of buying and selling pressure. So what that tells us is any sort of signals we get today on any of those types of indicators, we should take with a grain of salt. We better get confluence with other indicators that are not based on volume validation.
Yeah,
Otherwise, I don't think it has much to do with. I don't think we're going to see options expiration affecting any of like the stuff that we're talking about that could move the markets.
sure. And we still have some major geopolitical issues taking place every day, primarily, the war with Russia and Ukraine. But there's this chatter going on about Russia's ability to pay their foreign debt that I
Right.
keep seeing, and I'm curious, do you think that has any impact, and where would it have impact?
So I looked at that a little bit closer myself, and they said that for people who want to take their money out of Russian debt, they said, well, we're not going to pay you in any of the big currencies out there. We're not going to pay you in US dollars. We're not going to pay you in yen, Japanese yen. We're not going to pay you in euros or British pounds. We'll pay you in rubles, which are worth nothing as well. But the Russian debt is not like what we do here in the United States, where we sell a lot of debt. I mean, if you look at the amount of holdings held, especially by China and Japan, of the debt in the US, as well as, and again, we were talking about this last week, the amount of debt held by the central bank. They've printed money, and that looks at their balance sheet as debt. um, Russia doesn't do as much of that as we have. So um, it's going to be an insignificant, in my mind, an insignificant drop in the bucket, at least for the global markets. Maybe for somebody in Russia, that's going to be a problem, but for most of us, it's just kind of like a fart in the wind.
Yeah, and I think many corporations who did have ties there have been unwinding them over the past weeks to really limit that risk.
Totally severed it. I mean, really besides the consumer base in Russia, and that's questionable as well as how big that is. It's because Russia actually has quite a small population compared to some of the other countries like China and India. Um, uh, their main business is raw commodities, especially oil and agricultural products, and so that's where we're seeing it. Even though, like for instance, here in the States, we used very little Russian petroleum products. It's traded on the global market. So because, like for instance, Europe is also decided not to buy a lot of the petroleum products there, the price of oil has been quite volatile. And just remember, for those of you who are like watching the price of the oil barrel, but then getting a little bit frustrated behind what's going on at the gas pump, because the gas pump, remember, those gas station owners buy the oil or buy the oil futures at a certain price. And so until they run out of gas at that price and buy the next lot, the price of gas is always going to lag at the pump, is always going to lag the price per barrel. And since the barrel price is up and down, we can't get too mad when you see the price of oil drop back down below 100 and the gas prices, it's going to take a couple weeks for that to shake out, as well as, this has been a great time for some of the corporations to tax on a little bit of what I call a margin, profit margin tax. So there
Yeah,
might be some of that as well.
I always love seeing the common population comment on that interesting fact that it is a lagger. The gas you buy at the pump is a lagger, and it's been like that since the beginning. Basically, it's just how the market works.
I mean, my answer is it's time to invest in that Tesla.
Hey, we're there. We're getting there.
Get that EV.
All right, so one more news item that we may cover. Last week we talked about Amazon's 20-for-1 stock split,
Yep.
and we did some analysis there. And then yesterday they came out and finalized the acquisition of MGM Studios, which houses I believe, the James Bond and the Rocky franchises. And so I think you just pulled up the chart, and the market is liking that.
Yeah. So the scoop behind Amazon is, again, I like doing a simple retracement analysis to understand. And I know that some of the traders out there who are watching will say, hey, that's a slow indicator. I like to know what the tide of a symbol is doing. So, yeah, we got all this great headlines. I mean, Amazon is following the playbook of Apple, where they're bringing the price of their stock down because they know that there's so much investment dollar out there, which we also talked about last week. And I keep referring to last week was a great show, but what we talked about last week was that because of this very aggressive monetary policy that we've had for the last 3 or 4 years, where the Fed has been doing this bond buying to the tune of like $6 trillion. They've tripled their balance sheet with bond holdings. They've pretty much brought bonds down to not a viable investment. Historically, investors have been splitting their asset allocations between equities and bonds, right? You could get a nice paycheck from bonds. They're pretty much on a much lower risk than equities. And because bonds have gone to nothing, investors have been now looking for where to put their investment dollar. Now it kind of moves things to the right, where stocks and equities become the lower risk. And there's now a whole bunch of investment in things that are much higher risk. And that's why we're seeing just a ton of money flooding into things that you would never expect before, like SPACs. We talked about that on a previous show. NFTs, crypto, you're seeing all this money flowing into there because it just doesn't make sense to buy bonds. The Fed is on an aggressive path for the next for the foreseeable future, I would say before 2025, to reverse that. So I think we're going to start to see some of these bubbles. And the key behind if the Fed is successful or not is, can they deflate these bubbles slowly, or will they make them pop? But I think we're going to see over the next couple of years money flowing out of these very risky investments back into equities, options, and then that would be considered the risky ones. And then bonds are going to become more popular over the years. It's not right this minute, but it is there. So with that said, what Apple and Amazon have thought, and Apple was way ahead of the game, Amazon might be a little bit too late to the game, is since there's so much investment dollars out there right now going into really crazy investments, why don't I lower the price of my stock so that I can get some of those everyday investors who are, thinking about Dogecoin, thinking about, getting into real estate at its highest price, buying high rather than buying low, things like that. Why don't we entice them into Amazon stock? So that's great. And that caused a big pop. Actually, that caused more of a pop than this pretty high dollar. I think it was $8.9 billion acquisition MGM. but I still bring us back to the retracement. So looking at this chart, again, I care more about the closing prices, at least for this type of analysis. So I go back to my 3 and 5 day EMA, and I look for when I actually get crossings. So one here, and I don't count these like either 1 day little tests nor these very shallow tests. I want to know the actual crossings. Once I identify the crossings, I'm then going to go back and I'm going to look, because these crossings are lagging indicators. I'm going to go look for the low and the high right before those. And so in that case, I'm talking about this low and this high. And so if I set up my, and I don't have to use the Fibonacci, but I want to use some sort of percentage measuring device. Let me go ahead and turn on Snap for myself, so I can tag those points exactly. Boom to boom. It looks like, and I might have to do a quick adjustment because I put my little yellow line right there. So let me tag this one right there. Boom. Perfect. So I need to see Amazon going above about $3,225 before I believe in this uptrend, right? Otherwise, just like the S&P 500, I'm thinking that this, at this point in time, this might be just a test of continuing to move down. Until I get at least a 100% retracement, I'm not bought into the idea of going long on Amazon. But, we're not that far away. We're $75 away from that number. I'm not saying it's not possible. I'm just saying I'm not ready to jump in on Amazon. If anything, the same thing I said about the S&P 500, when we started to see this move up, either it's time to sell your short positions and wait to see what happens next, or it's time to buy some protective calls against those short positions and offset them with some sold put premium. Those are the two strategies I would be pulling out now, only if I get above 3,225, roughly 3,230. And even better if I can get above this number, 3,350. If I do that, then I'm excited. I'm thinking that Amazon has changed its posture and it's on its way back up. But until I see that, guys, I'm not ready to just gamble my money away.
Yeah, and general market pullback could keep this, coming back to the downtrend, even if Amazon
Correlation.
is doing good things.
Yeah, there's
All
so
right.
much correlation. You got to realize that these bigger stocks, especially, there's so many baskets of investments now, ETFs, indexes, that when an investor who wants to get kind of a broad swath goes and buys these things, and man, the market for ETFs and indexes is way bigger than even the individual equities. What it does is it causes all of the stocks to kind of follow the tide. So just like Sip said, if the market starts to go down, that's going to be pulling on Amazon. So
All right. So with that, if anyone watching has any questions or have any tickers that they want us to go over, go ahead and drop it in one of the comments, and we'll try and cover it. If you're watching for the first time and you haven't checked out AJ's workshop, we just went ahead and put the link in the chat. It's a daily workshop that does a very wonderful job of breaking down these strategies and kind of helping you understand AJ's approach to selling premium and some other strategies. So we're going to go ahead and play our little commercial there, and then we'll go over some examples and keep the show rolling. So here we go.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right.
We packed so much content in that webinar I think anybody who is anybody should spend the hour, go through that workshop, take a lot of notes. There definitely is a handbook that we emailed to you as well to go along with it. Even if you just grab that handbook, you'll get so much out of it. I think that, it's just like our general public kind of public service thing that we've done. And I think that that's great. So please go register for that workshop.
Yeah, servicing the public by helping everyone profit. That's how we approach, trading. So we were talking about Russia. Some of the news out of Russia was that all these banks pulled out. One of them being Goldman Sachs, and that kind of goes into our first question from Roy in Waco, Texas, who's curious about taking a long position in Goldman. He wants to know what you think.
All right, let's take a look. Let's take a look. Mm-mm-mm-mm. Okay, I'm going to zoom out a little bit to get kind of a historical understanding. I've been trading Goldman Sachs. It's been on the Trading Trainer watch list for over a decade. And Goldman Sachs is one of these companies, as is many of the other banks, that has periods of, trend, like we see here. This was back in October 2020 all the way up until May 2021. And then these great periods of sideways movement, which as option traders means paycheck after paycheck, right? Whenever we have sideways movement, option traders can sell premium and roll out protection and create paychecks on that, which normal equity traders, they're just stalled in a position, whereas we can turn that into a income source. And it looks like what Goldman Sachs has done for us is it's simply done an offset. It's done a step function decrease in price, but it still looks like it's in a sideways. Now, what I like to see is I like to see multiple tests of a new support and resistance. And some people like to say, hey, the previous support became resistance. I've actually seen plenty of patterns where you have a level of support whenever you push from the top direction, but it doesn't become, it's like a one-way door. So I'd want to see that this level is tested. Let me go ahead and zoom back in now that I've got the bigger picture. Let's take a look, Roy, at the more condensed picture. I'm going to come maybe to look at a 6-month chart. And so, yeah, I'd like to see this level of support resistance tested at $375. And I've already got a couple tests down here at $325. So I like that level of support. So I guess your question was, should I be buying? And my answer to that question is, if you're comfortable with Goldman Sachs as an underlying symbol, this is the right time to buy. And what we want to do is we want to watch what to do next. So I would put, again, on this top close here and this bottom close here, I would look at this number. Like I said, I guessed it, but the actual analysis tells us $375. And then these top numbers, if I get as high as $395, I would look for a selling opportunity. So buy down here where you are. This is a good buy signal. And then look for $395, even $400. Mark that as, hey, I'm going to take my profit. And of course, what I would do here is if it goes above $400, I would put in a tight trailing stop, and I would try to take advantage of as much gain as I can until it reverses, and I would just automatically get out of that thing. Now, as an option trader, if I decide to find a top before the $400 mark, which is, what I'm talking about, is there another test of this resistance? And I know that resistance I said was at 375, but I would take all the way up that resistance for me is a range between 375 and 400. If I reverse anywhere before $400, instead of taking my profit and moving on to the next investment, my knee-jerk reaction is, hey, let's go ahead and buy some protection to the downside, buy some protective puts, maybe 3 to 6 months out, probably closer to 6 months out, at the $320 strike price. And to offset the cost of these things, let's sell some near-term 410, 420, or whatever is right above wherever I reverse premium. That premium will offset this cost, and then this protective put I can roll out when it's no longer necessary, when I've come down and then I'm start going back in the long direction. So that's a long answer, but yeah, this is a buy signal. This also might be, if I've never traded Goldman Sachs before, Roy, if you have no familiarity, this also might be a great opportunity for paper trading it. See how it would work out, and then get in with real money on the next round.
Yeah, I feel like that's the first time we've gone over Goldman, which is definitely a popular position for a lot of active traders to be in. So
The beautiful part about Goldman Sachs SIP is there's so much liquidity. Goldman Sachs, like you said, is traded so much on the option chain. We have no problems with finding options to trade, markets of option traders to trade with.
yeah, it is a little bit more expensive, hitting 300 plus, which causes some problems. But some people in our program can handle those positions.
It is expensive. That's a good point.
All right, moving on. It's something that's continued to be in the news, something we just talked about, and that's oil. And Lydia, specifically the oil companies, and Lydia from Harrisburg is curious about your thoughts on Marathon Oil, ticker symbol MRO.
Okay. So Marathon Oil, very popular, and I like that price. That price brings it into the price for individual investors. So that's great. So Marathon Oil is again, I'm similar to what I'm thinking about with Goldman Sachs. I only have one test of resistance. I only have one test of support. So I'd like to, before I start selling a lot of premium against it, I'd like to see at least 2 tests of each. But again, that doesn't mean I can't either paper trade or real trade this long position. This is, a pullback, and we call that a swing trade. I'd like to look at some different indicators. So some of the more traditional ways to look at this is like look at a leading indicator for a trigger and a lagging indicator for a confirmation. One of my favorite combinations, if you're interested in that, would be, let's see if I've got it preloaded on my studies here. I like using the Williams percent R as my leading indicator. So you can see here, and Lydia picked up on this well, the Williams percent R, which is, how would you describe it? When the Williams percent R hangs out at the 50 mark, right in the middle, it means that the underlying symbol is going sideways, right? And then if it starts to go higher than the 50 mark, we call that overbought. And that means that, for instance, if it trades at 40 the whole time, it's overbought and it'll be trending. If it trades at 30, it'll be trending more aggressively. And as we get closer and closer, and you might have noticed that the Williams percent R starts at 0 up here and goes to 100 down here. It actually goes to a negative 100. So when I'm talking about 30, I'm talking about getting closer and closer. And the more that this is a lower number, the more aggressive the trend is going to be. So and then the other is true as well. If it goes below the 50 mark and starts heading lower, it means that there's going to be a pullback, right? And so what I like to look for in the Williams percent R is going to an extremely oversold position when I'm in an uptrend. So Goldman Sachs is in an uptrend, but yet it pulled back to an extremely oversold position. That means going below 90. Right here, we can see, I'm going to just put my cursor over it so I can see what that was. That was 88.8889, so 89. very close to that 90 mark that I'm looking for. So that's my leading indicator to say, hey, this position has been trending up and something has pulled it back like a rubber band. But I still don't want to use a leading indicator to signal my trade, the timing of my trade. Instead, I want to wait for something like a lagging indicator to say, okay, that rubber band was pulled. And instead of that rubber band being pulled so much that it breaks, it's actually starting to pull us back up. And that's the swing and the swing trade, right? And so having a closing above the 7-day simple moving average. So I know this says MACD, but if you look at my settings, it's the 1 and the 7. So the 1, if you take a 1-day simple moving average, what is a 1-day simple moving average? It's a freaking line on close chart, right? A 1-day simple moving average means it's the closing prices. So what I'm looking at here is when the 1-day crosses the 7. So every time the 1-day crosses the 7, this line crosses the middle, crosses the 0 line. So I just got a 1-day crossing the 7. So actually, Lydia, you've picked a good buy signal for a swing trade. And then the same thing that I said on Goldman Sachs is what you do next is the big deal. And so I would be looking to see whether or not I would want to sell, just take my quick 3-day, 5-day, if it's a week-long trade and sell, or does it make sense for me to, instead of selling, I'll instead sell some call premiums, near-term call, at the money, error to the side of out of the money options, and at the same time, buy some protective puts with a strike price down here around the 20 zone to hedge my risk. And then when the risk is no longer in my radar, I can sell those back for a profit. Those would be about 6 months out in time, 3 to 6 months out in time. So I think you've got, the people we have following us, SIP, really know their signals. So I think, Lydia, you've picked on a good buy signal. I would maybe, since I like to swing trade, I don't like to swing trade on Fridays. I might wait until Monday to see if that buy signal is still there. But yeah, getting into an initial position on these, especially an oil company, I wouldn't say is a bad idea.
Yeah, I mean, geopolitical does kind of have, some potential implications there. So thank you very much, Lydia. And thank you, AJ, for explaining the Williams percent R. I feel like I see that indicator all the time on my charts, and I never really understood how to read it. But that was definitely great insight.
One other interesting thing about the Williams percent R is that it's algorithmic. So each move 10 points is it's more extreme. So when I said going to 90, that means that, hey, that's a really strong pullback. And if it goes to 10 on the other side, that's a strong pullback in the other direction. It's not a linear move. It's actually kind of a parabolic or exponential move. I don't know if I just nerded out, but I think it's really Larry Williams is a pretty smart dude. I've seen him speak many times.
Yeah, I mean, if you create your own indicator, we should assume that you're a pretty smart guy.
Yeah.
All right. Well, we love having our new traders on and asking questions. And it looks like we have Milo from way up in Juneau, Alaska. Hello, Milo. And Milo is new to options trading, and he's curious as to what he should prioritize in terms of learning or approaches or strategies. And I think this is a great question, AJ.
Yeah, I'm glad we got that question. I got this question earlier in the week. I got it by email, and I actually talked about it during my group. So my premium sellers who actually are part of our premium selling group meet every Thursday night. We go over our favorite ticker of the week. We create a plan around it, and then everybody walks away with the plan so they can trade it in the next upcoming weeks. So last night, in addition to creating a plan around Infineon, which was the stock of the week, we also talked about this because this was such a good question. So with that said, Where I would focus, and I'm going to give you, I have the benefit that I've been doing this for a lot of years. And in addition, I've been in this teaching field where there's a lot of teachers, and you can find, you meet these people on the circuit and you find out who's actually, got a portfolio to back up what they've been teaching. I'm not saying that, teachers of finance that don't have big portfolios aren't good at teaching. I'm just saying that sometimes you want to have, especially in this field, you want to have somebody who has done it before they start trying to teach it. So the folks who actually have some backing to the education they're teaching, I've interviewed. In fact, one of these days I've been threatening. I've been doing this for over 15 years, taking all these interviews and throwing them into a book or something. But I've been looking for, like, what do they all do the same? And over the years, I've come up with these 4 things in this priority order. So to answer your question about what I would focus on or what I would prioritize learning, number 1 above everything else is risk management. I would figure out how to, on any one of your positions, how to make sure that you limit the risk. And so our knee-jerk reactions are use stop loss orders and or protective options, right? And what are the pros and cons of those 2 risk management things? So managing trade risk, but also the other part is position sizing. So with option trading, you have to remember that everything is done in lots of 100. So back to that Amazon thing, Cyprian made a good point, or even Goldman Sachs. Let's go back to Goldman Sachs. Cip made a point when we were looking at Goldman Sachs that, hey, it's kind of pricey. Think about it. In order to do just the minimum option trade on this, you need to have 100 shares of this stock. So the initial purchase of this, minimum initial purchase, is going to be $34,278 based on the price it's going at right now. So that's the initial purchase of going long the stock. You can buy a a substitute option at a cheaper price. But remember, those substitute options have leverage. So what I challenge you to do is actually determine, in whatever trading strategy you're using, with whatever instrument you're using, determine how much is the maximum you can lose. So where would you set your stop loss order? Where would you buy your protective put? If you bought a protective put, don't forget to add the price of that protective put into your math and determine exactly how much, in the worst case scenario, you could lose. And then go ahead and determine how much you want to expose your portfolio to. So, for instance, if I determine that if I buy some of that Goldman Sachs at whatever, and I get stopped out in the worst case scenario, I'm going to lose 20% of the trade, and I only want to be able to lose 2% of my portfolio in any one trade. That means my position sizing should only be 10% of my portfolio. If I only invest 10% of my portfolio into Goldman Sachs, and Goldman Sachs goes down and I get stopped out at a 20% loss, my portfolio will only suffer a 2% loss. I hope that math kind of works out for you. And so with that said, that means that my minimum purchase of $34,248, that's the going price. I see that bouncing around in my chart here. That can only be 10% of my portfolio, which means in order to trade this with options, I should have a portfolio over $350,000. If I follow basic risk management rules, there's no way I can be in a situation where I lose like more than 2% of my portfolio. And every successful trader knows how to do these calculations in their head. So that's number 1 thing I would focus on. And any newbie trader who has gotten themselves into a lot of hot water, I find that this number 1 priority that successful traders do, that they've done it wrong or they didn't even think of doing risk management. Number 2, This is just for option trading, but understanding option selection, right? How changing, picking the expiration dates and picking the strike prices, how that changes how the options behave. Because option selection, it's not just picking a call or a put, although option type actually does have an influence on it, but it's also expiration dates and strike prices. You need to understand how option pricing works. Do I go deep in the money? Do I go at the money? Should I go far out in time? Should I go near term? Should I go 3 to 6 months? All of that makes a difference. And then I guess the last two things, one of them would be, equity or underlying symbol. Let me put underlying symbol because a lot of times we can do option trading against indexes and ETFs, not just equities. Underlying symbol selection. And finally, um, timing of entries and exits. We've been talking a lot about that. We looked at the trade from Milo and no, not Milo, from Roy and from Lydia about timing, and they had already figured out the timing. And they were asking me, I guess, about the option selection and the risk management. So, timing, it's interesting when you go to one of these trade shows, you go out on the exhibit floor where all the exhibitors are there talking about their different tools. They all focus on timing and or maybe some filters on underlying symbol selection, which is actually the last on the list of prioritization around knowing what's best to trade. If you don't have risk management and, in the case of option traders, option selection down, you're going to go nowhere fast except maybe lose your money very quickly. And in that case, if you're going to go into trading without risk management under your belt, why don't you just I'll give you my personal address. Why don't you write checks to me? Because I'll use the money better than you just giving it away to the market.
Yeah, you can write me a check. You can write me a check too. I'll take a check.
Because I'm telling you, there's so many people, Sip, who do not do risk management. So, Milo, risk management, get it down. Just make it ingrained in you. Don't over leverage yourself, especially with options. Don't get yourself, make sure you can evaluate max risk. Make sure you can calculate position size. It's very simple, but very few newbie traders think to do it.
Yeah, and be sure to check out that workshop that AJ puts on. The link is in the chat. I know that you go over a lot of this logic and approaches in that workshop. So anyone else that's learning for the first time, go ahead and hit that link. If you're enjoying the content, go ahead and hit that like or smash the like or the follow button.
Smash the like button.
We'll be sure to get some more content your way. Feel free to drop any questions into the chats, any tickers that you want us to go over. And, anything we should be looking forward moving, into the end of the month, because it looks like we got about 2 more weeks left.
Well, like you mentioned, option expiration is for the monthly option is today. And so we're got our eyes on, if we're selling any sort of near-term premium, we are thinking about, the April expiration at this point. Generally, we like to go about 3 to 5 weeks out because things have been a little bit more volatile. And I'm talking more about the implied volatility than even the historical volatility. We actually have been able to go out only as far as like even 5 days to 2 weeks and still got healthy premium. So you weekly option traders out there, 2 weeks out is not bad for collecting a nice paycheck. We can start collecting more than just the monthly paycheck. We can start trying to collect paychecks every couple of weeks.
Yeah, and I'm assuming we'll start to get more inflation data coming out, which I think the market will react to because the next Fed rate is how many weeks out? Or, the next Fed meeting, what is that, like 6 weeks apart?
Usually it's like 6 weeks, yeah.
All right. So
I think that, I think what I've got my eyes on is from a technical perspective, I'm watching the S&P, like I said, see if it goes as high as 4,600. But the other thing I'm watching for, especially in the news, is an end to this conflict. I think that that's taken over a lot of people's hearts and minds, investors as well. And that would give people kind of a calm to go back and just be following like Fed news, inflation news, and what's in the market. So I'm looking to see that. I don't know much about politics, but I'm looking to see if they can just get out of this conflict, rebuild Ukraine, whatever it takes, but just stop the war and let us go on to more of our trivial news that comes around. Peace is underrated.
Yeah, and we're definitely for peace, and I think the American public and society would benefit from that peace, so that we can get back to rebuilding, our own systems following, 2 years of a virus that basically slowed everything down.
Well, and that's starting to pick up in the news, isn't it? That virus has got another mutation that's somewhere else. I think Hong Kong is. I think that it's taken over New Zealand, which was always the big player in this virus thing, and it's taken over Hong Kong. But in New Zealand, everybody was vaccinated, so there's very few people in the hospital. And in Hong Kong, not many people were vaccinated, and Hong Kong's being decimated right now. So got to watch out here because everybody's relaxed, thinking it's in our past. We'll see.
Yeah, we certainly
might be
will
talking
see.
about that in the next couple of weeks too.
Most
I hope
certainly.
not.
All right. So I guess with that, we'll go ahead and close things out. We do appreciate everyone checking us out. As we mentioned earlier, feel free to drop any questions in the chat. We will get back to them as quickly as we can.
Smash the like button.
Otherwise, we'll be back on next Friday. So thank you, everyone,
25th,
for watching.
25th.
That's right.
Yeah.
The 25th.
Bye, everybody.
All right, guys. See you later.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.